Thank you very much. So, good evening to all of you. Hope you're doing good. We have a super interesting session today. We're starting with the first reading of Level 2 Corporate Finance, which is capital budgeting. And it's a fun reading, fun primarily because we get to do a lot of numbers, very logical, intuitive. It's like solving puzzle. We're going to have a lot of fun with this. And my agenda for today is I'm going to spend about 15 to 20 minutes discussing basics. Then once basics are done, which I have anyways been doing with you in the previous two sessions, but I'll still go through it once in case if we have any new participants today. But once basics is done, then we will go on a particular type of case study called as the expansion case study. In the expansion case study, we would be doing two small examples just to give you a flavor of how these type of cases are to be solved. And then what I would be doing after that is I have picked up a case study, and this is going to be the most interesting part of the session today, where we would try to solve this case study in a spreadsheet. And if you don't have a spreadsheet, we'll try to do it manually, but it's going to be a lot of fun because it's a full-length case study that we would be discussing or solving today. Okay, so that's roughly the framework. And if all of you are okay with this, then I think it's a time we get started. So let's start with some basics first. So we discussed in the previous session that we need capital budgeting because we want to take investment decisions, right? It could be as simple as I want to set up a new manufacturing plant. I would have to invest into building, I'll have to invest into machinery. Should I do it or not, right? That is capital budgeting. So this capital budgeting analysis, which in theory is so simple, in practice is extremely complicated. And then there are certain principles which will help us take that decision. These principles were a part of your level 1 curriculum, but I'll still do a super quick revision of them. The first principle says that decisions are based on the cash flows. What do you mean by that? So in generally finance people, we always keep on talking about profitability, right? Profits. But you don't want to take a decision based on profitability. You want to take a decision based on the cash flows. And we know that it is not necessary that the amount of profit and the amount of cash flows would be exactly same. It is quite possible that these are different numbers. So that is a simple statement. Second, timing is important. Yes, if I am receiving 100 today versus 100 1 year from now, these two are different amounts. So timing matters. So I was discussing about basic principles of capital budgeting. I don't know you missed from what point, so I am going to kind of repeat everything for you. So first point there was that decisions are based on the cash flows. What do you mean by that? It simply means that you don't want to take a decision based on profitability. You want to take a decision based on the cash flows. How much money is coming in, how much money is going out. That's straightforward. Second, timing is important. The amount of money received today and the same amount received after 2 years, it's not the same thing, right? These are different amounts. So timing of the cash flow is important. The third concept is you have to consider opportunity cost. Now, what do you mean by opportunity cost? So this was the example that I was going to build for you, or I was building for you. So imagine we have a owner of a particular building, okay, and this owner is also considering starting a new business. So this is the building, and he can do two things with that building. So option one is he can just rent out that building, to someone else, and he can get that rental income. Or option two, that you can use that building in your own business. Okay, so use the building. I can see that this part is not visible, so I'm going to write it here. Use in the use in the own business, right? So these are the two options that he has. Now, if he decides to use this option, and imagine had he decided to rent it out, he would have, let's say, received a rent of $100. So what we will say is, if he's doing a business, then he will have to consider opportunity cost of $100. Okay, again, sorry, I'm writing at a wrong space. He will have to consider, let me write it here. He will have to consider opportunity cost of $100, right? So that's the idea here, that in capital budgeting decision, even if I am not paying that $100, right? It's my own building. I am not going to pay that $100, but I will still have to consider that while taking the capital budgeting decision. That's what we mean by point number 3, which is consider opportunity cost. Okay, I will repeat. I will give you opportunity to ask questions, but just try to get a hold of them. Then fourth, consider taxes. This is straightforward. Every time I'm making some profit, I have to pay taxes. So all your decisions have to be on an after-tax basis. So what does it mean? It means if I do this business, it will get me 100 more, but I will have to pay 30 of taxes. So my effective cash flow that I should consider is 70. And finally, the last point, which says ignore financing cost. It's a super important point. What does it mean? It means, and listen to me very carefully now, it means that we should not consider interest as a cash outflow. Okay, now prima facie this seems counterintuitive, but it is not. It is actually a very solid point. I'll show you why. Okay, so I'm going to give this a heading: ignore financing cost. Ignore financing cost. Okay, now what does it mean? So the example that I built for you a couple of days ago in the basic session, I'll do that again. So we have an individual. What this individual does is he borrows, let's say, $100. Okay, he borrows $100 at the rate of 10%. Now he takes that $100, right? So he has that 100 with him. Now he takes that $100 and he puts that into, let us say, market. He puts that into some sort of an investment vehicle, and by the end of the year he's been able to generate 125. Now he's invested 100 and by the end of the year he received 125. What I want you to do is, based on this information, I want you to calculate NPV for this particular project. So when we are calculating NPV, what are we going to do? Observe here. We will draw a timeline. On a timeline, we will say time 0 minus 100, time 1 125, right? These are the cash flows we are going to insert into our cash flow function of the calculator, and it will ask us for the discount rate. That discount rate we will keep it as 10%. So I want you to do this super fast and tell me what the NPV number is. Okay, so I'm going to do this along with you. So what do we have here? We have 125 as future value, 100 negative is present value, 1 is N, compute IY. Sorry, what am I doing? I'm so sorry. Cash flow, second clear work, 100 negative, enter. Cash flow 125, enter. NPV 10, NPV, so I'm setting I as 10 and I'm computing NPV and I'm getting 13.63, right? Now notice what happened here. Notice what happened, and this is probably the main important point that we take away from this, that, let me just pull it out somewhere here, that we did not even consider that we have to pay $10 to the bank, right? But in bracket, just to save myself, in cash flows. Did you notice that we did not even look at this left side of it? We did not even say that that $10 should be deducted. Why did we not consider that? Because that financing cost is captured. I don't know if I have the space to write. Financing cost is captured in discount rate, right? So you don't want to double count it. You don't want to count the same cost twice, and therefore the basic principle that we should ignore the financing cost. So hopefully this makes sense to you. So we have these 5 principles. Which are the 5 principles? Decisions are based on cash flows. Timing is important. Consider opportunity cost, taxes, and ignore financing cost. On these 5 points, if you have any questions, you can ask me. In the meanwhile, I realize that you cannot see this particular point that I've written, so I'm going to write it at the top. Okay, so I'm going to write that point somewhere here. In the meanwhile, you can post your questions. If you have any questions on the 5 basic principles of capital budgeting, please ask me now. Or just put it in the chat box and let me know that you're okay with them. Then probably I'll move forward. Okay. So hopefully you've understood this. Someone has asked, is implicit cost and opportunity cost the same? Yes, it can be. A lot of implicit cost are opportunity cost. So we can think of it that way. What exactly is 13.63 number? Assume that 13.63 is the NPV of this particular investment project that we have considering. 13.63 is the NPV, net present value. Someone is asking how timing affects. Timing affects because 100 received at year 1 or year 2, these are different amounts. So you have to consider the timing of the cash flows. Can I repeat the 5th one? Samruddha, 5th point says, do not consider interest as a cash outflow. Why? Because it is considered in your cost of capital. It is considered in your discount rate. How is it considered in the discount rate? This 10%. Shreyas has asked, that's a good question. He said, can we say that opportunity cost is the same as a rate for internally generated funds? Shreyas, that is the opportunity cost for the capital, but that is not the only opportunity cost. We can have an opportunity cost on real estate, opportunity cost of labor. We can have variety of opportunity cost. Someone is asking, Rohit is asking, shouldn't we add tax saving to the interest? So here the assumption is that this is after tax or the tax rate is 0. The tax part, we'll worry about that later. Okay, so we've spent enough time here. Now let's do some basic terms super fast. The first term in my list, it might not be very clearly visible to you, so I'll just read it out for you. It says cannibalization. Okay, so every time you have to think of cannibalization, there is an example which is super useful. Some of you might have heard that example from me in the past. Let me write that here. Cannibalization. What is the example? Example is Coke versus the Diet Coke, right? or this iPhone 11 versus the 10 versus the 9 and so on. Now what do you mean by cannibalization? So as a firm, when Coca-Cola decided that we will introduce Diet Coke. Why? Because we want to capture that segment of the market. What they should consider, that when we introduce Diet Coke will eat out some part of the business of the regular Coke, correct? So that is called as cannibalization. It's a part of an externality, and even that needs to be considered. How? If I'm doing a NPV for, okay, again sorry, I'm writing on the wrong part of the screen, but if I'm doing a NPV for Diet Coke project, if I'm doing NPV for Diet Coke project, then what I will say is, I will say that my sales of Diet Coke are going to be 500, but 50 worth of regular Coke sales will reduce. So my effective sales is going to be 450, right? That's how I need to factor in this cannibalization into my calculations. Then what is the next term? Next term is the conventional versus unconventional cash flow. Now what is conventional and unconventional? Okay, I'm just preparing you so that we do some very beautiful case studies very soon. So next concept we have to look at is conventional versus unconventional cash flows. Now I'm going to write an example so you would understand. If you have a project which has a cash flow like this, -50, -50, -70, then 100, 150, 200. This is a conventional cash flow. But if you have a project like this, -50, 100, -50, -50, and let's say 150 and -70. For example, if you have a project like this, then we will call it as unconventional. Now, why do you need to classify the cash flows as conventional and unconventional? Very simple. If the sign is changing, only once, then it's a conventional cash flow. Where did it change? From negative it became positive here. But if sign is changing, more than once, again I'm writing at a wrong place, I'm sorry, it will take a little while to get used to it. If sign is changing more than once, then it is unconventional cash flow. Okay, so how do we know it is unconventional? Observe, from negative to positive, then again positive to negative, then again negative to positive, again positive to negative. Even if it happens twice, it becomes unconventional. Now why do we need to know whether a cash flow is conventional or unconventional? If you remember a bit of your level 1 corporate finance, that if you have an unconventional cash flow, then what you would have is, you would have issues with, you tell me, issues with what? There's one particular number you cannot calculate very comfortably with unconventional cash flow. What is that number? That number is called IRR. Okay, so at level 2 curriculum just throws up this term, so we will just know it, that what is conventional, what is unconventional, and we know that if it's unconventional, then we are going to have issues with the IRR. Okay, so I'm not spending time here, but I'll be happy to take your questions once I finish the discussion. What do we have then? Next one is sunk cost. Okay, sunk cost, I'll give you an example. Sunk cost. Sunk cost is, and this example I'm giving you from a book called Thinking Fast and Slow by Daniel Kahneman. So I'm going to give you an example that I learned in his book. He's basically considered the father of behavioral finance. And example that he gives us, so with my mediocre drawing skills, but think of this as a some sort of a restaurant where a family is sitting and having their dinner. Okay, now this is a kid. Okay, and what kid does is he orders a dish, and he doesn't want to finish it now. The kid, his ordered dish, and he doesn't want to finish. Okay, but he's a father, so father says that no, you have to. It's expensive. Okay, so whatever dish you've ordered, it's expensive. So kid replies, he says, father, or he says, dad, have you heard of sunk cost? Have you heard of sunk cost? So what do you mean by that? It means it doesn't matter whether I eat it or not now, that money is gone, right? I mean, we have to pay money irrespective whether I eat it or not. So that is a sunk cost. Another example of sunk cost would be the fees that you people have paid to the CFA institute, right? If you've enrolled for CFA exam, you've already paid the money. Now that money is already gone, isn't it? So there's nothing you can do about it. A classic example is so I worked in consulting business for quite a number of years, and let's say that let's say that I got a new client, and it happened to me, by the way, once. A client came to me, and he wanted to set up a manufacturing unit for distilled water. Okay, so what this client was owning multiple gas stations or petrol pumps, and he wanted to set up a manufacturing plant for distilled water, and he wanted to do that project analysis. Now what we did is we basically onboarded the client, and honestly at that time I did not know the industry well. He paid us the fees, and we did a detailed analysis, and after the analysis we told him, see, it's not a good idea, you don't go ahead with it for whatever reason, financial and market and technical reasons. But the client got furious because he said that I have paid you the fees, how come you're saying no to me? So then and this client was kind of some sort of a kind of a criminal background, so to say. I shouldn't say criminal, but he had that kind of a personality. So we said okay, fine. And then we did the work again, and we said okay, fine, you do the business. Of course, we gave him a lot of conditions for why the business will not work, but the idea is the fees that you pay to a consultant again is a sunk cost, right? Because once the fees is paid, it's paid. There's nothing that can be done about it. Any decision that is already happened, any money that is anyways going to go, is a sunk cost. So hopefully that makes sense to you. Then opportunity cost we've already discussed. Next concept I want to discuss with you is incremental cash flow. Incremental cash flow. I'll give you plenty of time to ask me questions. Just try to pick up the concept right now. So let's look at incremental cash flow. Incremental cash flow. Okay. So let's do an example with which we can relate right now. So let us say you have a shop, and what you sell right now is you have a shop outside some sort of a tourist place, and right now you're selling some sort of a souvenirs, okay, or you're selling, let's say, handicrafts right now. Okay, and what happens is right now your sales is 100 rupees per day. Now someone gives you an idea, and he says, why don't you invest into a refrigerator? Why don't you invest into a refrigerator, let's say a total amount of 500, And when you do that, what will happen is your total sales will become 120, right? So if you invest into a refrigerator, your total sales will become 120. So when we want to take a capital budgeting decision, how we should do it is, we should say initial investment. I'll change my color here and I'll try to not go on the left corner of the screen. So when we are doing a capital budgeting decision, the decision will look like this. Initial investment 500, because to buy that refrigerator I have to pay 500, but my cash flow in year 1, I will not take 100, I will not take 120, I will take 20. That's the incremental cash flow for year 1. Of course, in future the cash flow will change. I'm just giving you an example of how to think on an incremental basis. Even if I did not have the refrigerator, my sales was 100, right? But by adding refrigerator, my sales became 120. And in fact, don't even let me refine my language. Instead of saying sales, let me just say cash flow, so that the question of cost doesn't come in. So this was a cash flow and this was also a cash flow. So we will say that incremental cash flow is 20, and that's what we will take decision with. So this is what I want you to know, that what is an incremental cash flow. Of course, at level 2, in tomorrow's session, I would be doing some replacement case studies where you would get to learn this more in depth. Yeah, so I've spoken a lot. I think I've more or less covered all the basics. I've just not covered one term, which is externality, which is same as cannibalization. I mean, cannibalization is a type of externality. So now you can ask me questions. I'm taking a small pause of 30-40 seconds and just throw your questions at me. I'll be happy to answer them. Alright, so I've got one question from Ayula. Question is, cannibalization is not clear. Okay, cannibalization means eating your own business. Okay, so in financial terms, so if I have right now one product, and if I launch one more, so that new product will get me some sales, but it will also eat up the sales of the existing product. So I have to consider that when I take the decision. That is called as cannibalization. Okay, Yash is asking, what happens if the consultant fees is based on the project performance? Yash, then it becomes a relevant cost. Then it's not a sunk cost anymore. Aditya says no questions, please move on. Perfect, Aditya, thank you very much. I'm still taking a 10-15 seconds pause. If you have anything, ask me now. If there's anyone who logged in late to the session, I haven't started anything technical yet. I'm still working on the basics. But the first learning outcome of level 2 happens after this, in 30 seconds from now. Okay, so moving on now. I'm going to do so in terms of our agenda for the session, as I told you for the beginning of the session that I will do some basics with you, and now I'm going to start with the interesting part of the session, which is an expansion case study. Okay, so I'm going to build those case studies myself, and I'm also going to show you the difference between CFA level 1 and CFA level 2 calculations. So I think your respect for CFA program will also go up once you see this, in terms of how beautifully this, at least the corporate finance part, has been structured. So at CFA level 1, a typical question would look like this, and at CFA level 2, the question is going to look like this. At level 2 to level 1, at level 1, the cash flows were, it seems I have missed some question. You can ask me these questions later on. Again, I'll keep on giving you opportunity. At level 1, they will give you data like this. They will say that at time 0 you invested 1000, and at time 1, time 2 and time 3 you received 500, 600, 700. Not only that, at time 3 you shut down your business and you sold your machinery and you received another 500. And then they will tell you that cost of capital is 10%, and then you would be required to do the NPV. Okay, so I want you to do this NPV for me just as a super quick warm-up. Calculate the NPV and throw the number at me, please. I'm going to also do this parallelly on my calculator. So I'm pressing the cash flow button. Cash flow 0, I'm making 1000 negative. I'm pressing downward arrow. Cash flow 1, 500, 600, 1200. Cash flow 3 is 1200. Pressing the NPV button, 10, compute. Parmindra, again, that's a great question. Ask me when I give you the next window. So NPV I'm getting as some of you did super fast, 851.99. Wherever I'm impressed. Your NPV is 851.99. This is what we learned at level 1. Now at level 2, first point of discussion is going to be on how to calculate, how to figure out, or how to calculate initial investment in the business. So we will have to do some math, not very intensive, but we'll have to do some math on this section. Then we will also have to work on how to forecast. At level 2, we will have to work on how to forecast operating cash flows. So they will give us sales, they will give us operating cost, taxes, depreciation, this, that, and then using that we will have to forecast operating cash flow. And it doesn't stop there, because we will also have to develop the skill that how to calculate. I don't want to, okay, I think I'm writing on my video. Sorry for this. And we also have to learn how to calculate the terminal cash flow. How to calculate terminal cash flow. Okay, so these are the 3 things that we have to learn to calculate in a typical capital budgeting case study. And throughout these three calculations, we have to keep in mind that one very challenging trick on the exam and even in practice is going to be to consider the impact of taxes, right? Because every time you're increasing your cash flow, you're increasing your profits, you'll have to pay a little bit of taxes in the process. So with this, I'm taking you to your first case study. I have already given you the hint on how to solve this. When we do a case study, on the face of it, it looks really big, right? It looks like it's too much to calculate. But if you break it down into 3 parts, which 3 parts? Calculate initial investment, how to forecast operating cash flow, and how to calculate terminal cash flow. If you can do these 3 parts properly, you're going to get your answer right. So let's do the case study. I would like to create the case study on the spot. And what I would recommend is you don't have to write because anyways it's going to be on your screen. You can start solving it directly. So I'll start giving you data. This is your example 1 expansion case study. Okay, it's an expansion case study. What do you mean by expansion case study? That means you're expanding the business or you're starting a new business. So you have decided to start a new let's say IT, no, let's not do IT company. You have decided to start a new manufacturing unit. new manufacturing unit. So what I will do is numbers I will write in a larger font and description I'll write in a smaller font so that I'll be able to make use of my screen properly. Now for new manufacturing unit, you will require to purchase property, plant and equipment. You will be required to purchase a new property, plant and equipment worth, I'm going to keep numbers really simple, $500. Not only that, you will have to invest in net working capital. Okay, so at level 2 capital budgeting, this thing will keep on coming, so you need to know this well. What do you mean by net working capital? So net working capital is if you're setting up a building, you have to have some cash, some inventory, accounts receivable, but you would also get accounts payable. So current asset minus current liability is your working capital. Just think of this as an investment. Okay, so net working capital of 200. Now once you set up the business, you would be able to make sales of 400. You will be able to make, no, 400 is not sufficient, I'm sorry. You'll be able to make sales of 800 per year, 800 per year for 5 years. You'll be able to make sales of 800 per year for 5 years. Fixed cost per year would be $100, and variable cost will be 30% of sales. Fixed operating cost per year, fixed operating cost. Now this fixed cost does not include depreciation. Depreciation is separately. Depreciation not included in fixed cost, not included in the previous $100. So depreciation would be 20% per annum. Okay, I think depreciation would be 20% per annum on a straight line method. Straight line method means every year you charge a constant depreciation. Okay. Tax rate is 30%. Project life is 5 years. Project life is 5 years. And let's add some flavor to our case study. So let us say that at the end of year 5, we will sell that property, plant and equipment at the end of year 5, you can sell a property, plant and equipment, let us say at a price of $200. Now that's it. This is a very simplistic representation of what you'd see on the exam. Now what will happen on the exam? The structure of the case study would be same. The complications will increase, right? It would be a little more complicated. There would be little more varieties. I have taken a very complex case study for you as well. So once I do 2 basic examples, I'll take you to the advanced level of case study. Now the first example, what I will do is I will give you this is about 7:44 in my watch, so I will give you 6 minutes, okay, so that you can try to process this and see if you can solve yourself. After that I will solve this along with you. We will solve it together, and then It seems many of you have started getting the answers. I have not given you discount rate, have I? No, discount rate, take 10% per annum. Discount rate, take 10% per annum. Yeah, by the way, unless otherwise mentioned, if I forget, 10% is a good assumption for you to work with. Okay, so I'm getting different answers here. Someone has given me, Arpan has given me 503. Sorry, that's Aparna. Ritvik has 925. Rohit is 948. Motivation 1% says no. Okay, motivation 1%. I don't know what that no means. Sushmit has given the cash flow. Tanmay 845. Aditya, depreciation is not a cash outflow, alright. Vikas says volume issues. Because audio is same as what it was earlier. I don't see any reason why it should be different. But if you're still experiencing audio issues, let me know. Do you want me to be louder, or is my audio alright? I did not change anything, so I'm hoping it's the same audio. Please confirm if the audio is okay. Guys, can you confirm if my audio is okay? Okay, thank you, Vikas. Okay, wonderful. Thank you very much. Right, so all right, thank you guys. So I'm going to solve this now, and we're going to have a lot of fun solving this. Thank you very much. We're going to break our discussion down into 3 pieces. Okay, so which 3 pieces? First, we have to figure out, so let me draw 3 boxes here. Okay, so box 1, box 2, and the major box 3. First, we have to figure out what would be the use a different color here, initial cash flow or initial cash outflow, right? Then we will have to figure out what would be the terminal cash flow, which is going to be the second part. And then third, we will have to figure out what would be the operating cash flows, which is going to be the third part of it. If we can figure out these 3 pieces, then it's a very simple, straightforward NPV question, correct? Let's start working on the initial cash flow first. We're starting a new unit. We have to buy the property, plant and equipment. So obviously that's going to be the first part. So property, plant and equipment. Let's see how much we have to invest. We have to invest 500 there. But it doesn't stop, because not only that, we have to invest into our working capital as well. So we have to invest in net working capital. What is net working capital? It is current asset minus current liabilities. Net working capital is nothing but, okay, I'm sorry for this. Net working capital is nothing but current assets minus current liabilities. So net working capital, how much is that? It is 200. So my total upfront investment becomes 700. Now here's your first trick for the day. This net working capital item is always a tricky one. Okay, why? Because what is happening with net working capital? When I'm starting a business, I will keep some cash with myself, which I will generally rotate, convert cash into inventory into accounts receivable to cash again, right? I'll keep on rotating it. So imagine when I shut down the business, right? So when I'm shutting down the business, that inventory and all of that stuff is still there, which I will be able to convert back to cash. That's the assumption. So if nothing is mentioned, always remember that this net working capital becomes an inflow at the end of the business. So generally what they do is they give you a release ratio. What do you mean by release ratio? Had they said that we will release 60% of net working capital, then your inflow at the end would be 120, 60% of 200. But right now, I'm going to, since question does not mention anything, I'm going to assume the entire net working capital is released. So net working capital, the whole of 200 is an inflow at the end of it. Okay. Now, since it's a tricky concept, I'm taking the liberty and repeating it one more time. Whatever we invest in the net working capital, if the question does not mention anything, we release the whole net working capital at the end. Otherwise, the question will give us some sort of a release ratio, 30%, 40%, 50%. Then whatever is the release ratio given, we take original investment of net working capital, multiply with the release ratio, and that becomes your inflow at the end of the business. Okay. So hopefully this is okay with you. Now let us start calculating operating cash flows. So for operating cash flows, I will give you opportunity to ask question, but don't post them now. Post them when I ask you to. So for operating cash flow, we will have year 1, year 2, year 3, year 4, year 5. Now I don't have to do it for 5 years because the numbers are same. But I'm doing this just to establish this as a practice, because in my next example, the numbers for every year are going to be different. So just to get you used to that method, I'm going to do this for 5 separate years. So sales each of the year is going to be 800. So let me plot 800 for each of the year. 800, 800, 800. Then let's take care of the cost. So we will have fixed cost. We will have fixed cost each of the year. How much is that going to be? That is going to be 100. So I need to deduct that fixed cost, right? So let me write that 100 here. So I'm writing 100 for each of the year. Then I will also have a variable operating cost. And how much is that? That is 30% of sales. So 800 into 30%. So that is going to be 240. That's going to be 240 again for each of the year. Then we've taken care of variable cost. We also have to take care of depreciation. Now there is a probability that on the exam they might try to trick you. They might say that initial investment also included some land. Okay. So if there's a land in the initial investment, you're not going to charge a depreciation, right? Because we know that there is no depreciation on land. But in this case, we have a property, plant and equipment, and they've given us a 20% straight line method of depreciation. Can you observe? So it's very simple. I will take 20% of 500. So my depreciation for each of the year becomes 100. So once I have done this, what I'm going to get is I'm going to get something called as a profit before taxes. Profit before taxes. Had they given some sort of a bank loan and interest rate, will I take that into consideration? No. Had they given bank loan and interest rate, will I take that into consideration? No. Why no? Because interest is a financing cost and we do not consider financing cost as a cash flow. It gets captured into your discount rate. Some of you might think why I'm deducting depreciation. You'd learn that very soon. Okay, so just be with me on this. So let us calculate the profit before tax. So how much is that going to be? That's going to be 800 minus 440. So each of the year my profit before tax is 360. Okay, but wait a minute, because we have to take care of taxes here. So let's see what taxes we're looking at. Tax rate is 30%. So on 360 we'll have to pay 30% taxes. So each of the year we will have to pay taxes of 108. I just calculated 30% on 360, so we have to pay taxes of 108. So what we will get then is profit after taxes, not cash flow. We're not doing cash flows yet, we're just doing profits. So how much is that? So that is going to be 252. Okay. Now what we do in the final leg is, and probably the most important leg, we look at all of these items, and all of these items are cash items except one. There is one item, I want you to tell me which one, which is non-cash expenditure, where cash is actually not going out. Tell me which is that expenditure. Correct, that expenditure is depreciation. That expenditure is depreciation. So what I will have to do is, since I have deducted it, now I will have to add back. So I will say add back depreciation. How much is that? 100 for each of the year, 100 for each of the year, 100, 100, 100, 100, and then I will have 352, 352, 352, 352 and 352. This is called CFAT, cash flow after taxes. Okay, but we haven't finished the calculation yet. We're still left with that final piece of it. So what is the final piece? That at the end of 5 years we are able to sell the PPE for 200. So that when we sell the PPE we will get another 200. But hold on a minute. Why? Because on this PPE, keep all your questions on hold, ask them when I give you a chance. Right now just try to learn. On this PPE, what is the book value of this PPE? So book value of this PPE, so observe we have charged depreciation of 500 so far, and the cost was also 500. So 500 asset, 500 depreciation. What is the book value? 500 asset, 500 depreciation. What is the book value? The book value would be 0, but you sold it at 200. So if you sold it at 200 and asset book value was 0, what's your profit? Your profit now is 200. And if you have a profit of 200 and its tax rate is 30%, will we have to pay taxes? Yes. So that's another trick. That's where again, so there are 3 tricks in the question. One was net working capital, second was the depreciation adjustment, and third we have to consider that we have to pay taxes on sale of PP, which is going to be 30% of 200. That's a negative item here. So now let's take a total. So 400, 360, we are looking at 340. And once you've done this, then the remaining part is really easy to solve. So what do we do in the remaining part is we simply plot all the cash flows and do the NPV calculation. So let's see how that's going to look like now. Plot all the cash flows and let's do the NPV calculations. So at time 0, how much money went out? 700 negative, time 0. then time 1, time 2, time 3, time 4 and time 5. So year 1 to year 3, each of the year we kept on receiving that 352. We've received 5 such payments, but it doesn't end there, because what we have also received at the end of year 5 is 340. And these are the cash flows. These are the cash flows that we have to enter. So I will write 352 here one more time, 352. So these are the cash flows we have to enter into our cash flow function. Keep discount it at 10% and then compute NPV. And I want you to help me with it. I'm going to do it though on my calculator. Cash flow 0, 700 negative, enter. Cash flow 1, 352, enter. And 352 gets repeated 4 times, so I'll keep the frequency as 4. And here I will keep 352 plus 340, enter. Then I will hit the NPV button, I as 10, and compute NPV, and I'm getting answer as 845.47. So there you go, that's how you do it. And if you're able to do it even 50-60%, congratulations to you, because the next example you'd probably be able to handle the whole 100% of the calculations. So I hope you enjoyed. Now I always say this, the first, when you get introduced to a new concept for the first time, that time is probably the steepest part of your learning curve, which you experienced in the last 10-15 minutes. So if you have any questions, post them in the chat box. I'll be happy to answer. Whatever you have in your mind, just post it there. I'll try to answer as much as I can. Ayula says the trick got me. Yeah, it happens all the time if you're doing it for the first time. Right, okay. So first question that I've got is on this trick, the taxes. Okay, so I'm going to explain that again. Jatin, Ankit, I'm going to explain this part again. Listen to it carefully. It's not difficult. See, you bought an asset for 500, right? You bought an asset value 500, okay, at time 0. Now you charge depreciation of how much? 100 every year. So 100, depreciation of 100, and for how many years? 5 years. 5 years, right? So what is the total depreciation? Total depreciation of 500. So you bought the asset for 500. This is the purchase price. 500 was the purchase price, and you charge depreciation. So what is the book value left? Book value is 0. But what was the sales price? What was the sell price? Sell price was 200. So if sell price was 200, what is your profit? Your profit has to be 200. And if this is your profit, how much taxes do you have to pay on it? 200 into 30%. 200 into 30%, I'm writing it here, 60. So there you go, that's how we got that 60. Rakesh has put a test there. Yes, do we need to remember the depreciation table in the curriculum? Why does NWC have tax effect? Lastly, when calculating profit on the sale of asset, do we take book value or tax value? Okay. So Yash has asked multiple questions. Let me try to answer them one by one. First question, in the CFA curriculum, they've given a depreciation table as per the taxation laws in the US. Do we need to remember it? Absolutely not. Okay, so that is just the indicative table. Please do not remember the table of the depreciation rates given in the CFA curriculum. If required, that table or the depreciation amount would be given to you. Second, he's asked, why does NWC does not have a tax effect? Yes, in this question, there was no question of tax effect because we invested 200 We released 200, so that's out of question. Third question Yash has asked is, when calculating profit on sale of asset, do we take book value or tax value if tax value is given? Yes, if tax value is given, of course we have to consider the tax value. But again, as far as level 2 exams is concerned, I don't think that's going to be a really question. The book value or the tax value is going to be same on the level 2 exams. Gajendra says, I enjoyed. Okay, thank you very much. I enjoyed too, Gajendra. Some excitement in these gloomy days. Honestly, I look up to these sessions. I mean, generally in my schedule, morning 9:30 to 3:30 is a fun time because markets are open. But after that, it was quite dull for a few days. But now that these sessions have started, I am happy as well along with you. Tahir is asking, can you explain the NWC part? Yes. So Tahir, you're starting a business, right? So you need to invest a little bit. You have to build the building, plant and machinery, everything, but you also need working capital. So whatever amount you invest into working capital, that's your initial outflow. But when you shut down the business, just imagine that you have sold goods on credit to people and you shut down your business. We are assuming that those people will give our money back, right? So that is called as a release of working capital. So that becomes an inflow in the terminal cash flow. I've intentionally avoided using sign here. So initial cash flow, it was assumed to be an outflow. So when I've written a positive number, it actually meant an outflow. And a terminal cash flow is assumed was inflow. So a positive number is inflow and negative number is outflow. Okay, but just to keep things easy, I avoided using the signs. Okay, let me Ying is asking why net working capital is added to terminal value. Hopefully, Ying, I answered your question. So here's how I want you to think. When I started my business, I added 200 to my working capital, and just think that 200 worth of inventory was purchased. Now, when I shut down my business, what I did is I must have had inventory of 200 that time. I converted that to goods, I sold it. So now I have an accounts receivable of 200. Will I get that accounts receivable back? Yes. Correct? Or I just have inventory with me. So will I get that inventory back? Yes. So that's what that release of working capital is. Alfred is asking, is it assumed that accounting depreciation is equal to tax depreciation? So Alfred, here the depreciation rate that I've given you, that was assumed to be a tax depreciation. Okay, in capital budgeting decision, you charge depreciation as per the taxation law, not as per the accounting law. Okay. Can you guys just put in that you're comfortable or not comfortable with this question? So if I feel the majority, if you're comfortable, I'll take you to practice example 2. Thank you, Vaibhav. Richa, keep it on hold. Ask me in the next question. Okay, so comfortable. All right. Thank you guys. I just need to answer one question before I move on, and I think that's an important question that needs to be answered. Someone asked me, I forgot the name, I think I just skipped through it. Who is this? Satish Babu has asked that if anyways we were to add depreciation back, then why did we even deduct it in the first place? And just think of it, if we have to anyways add back the depreciation, then why deduct it in the first place? And answer to that question is, Satish, if I had not deducted the depreciation, the amount of profit would have been different. Profit before tax. And if amount of profit before tax would have been different, then the amount of taxes would have been higher, right? So this is the true amount of tax that I'm paying, because the depreciation is a tax deductible expenditure. So the reason why we first deduct depreciation is to get the profit so that we can get the tax. But we know that depreciation is not paid in practice, so we have to add it back. But that was a great question, so thank you for asking it. Okay, so now with this background, let us do example number 2. Do you want me to make it a little more difficult? Okay, so I'm going to make this more challenging. I'm kind of not going to write in this area. Okay. So again, we're starting a new business, and let us say PPE investment. PPE investment is 1,000. I'm keeping the numbers easy. Then net working capital investment is 400. Then sales for the first year would be 1,200, and the growth rate in sales would be 25% per annum after first year. So your sales will keep on growing at the rate of 25% per annum. Then your operating fixed cost, excluding depreciation would be 200. Your variable cost would be 30% of sales. Tax rate will be 40% of sales. Tax rate would be 40% of sales. Sorry, did I say sales? That was stupid. Tax rate would be simply 40%. Depreciation rate year 1, 2, 3, 4 and 5, it would be 40% in year 1, 20% in year 2, 20% in year 3, 10% in year 4, 10% in year 5. So we have depreciation rate 40, 20, 20, 10, 10. So how much is that? 60, 80, 90, 100. Now PPE is sold at year 5. PPE is sold at year 5 for 400. PP is sold at year 5 for 400. And what else do we need here? Discount rate, we will just keep it at 10% just to kind of cut down on the complications. And discount rate of 10%, what do we need? Yeah, more or less we covered. So that's it. With this information, get started. You have sufficient data to get initial working capital, initial cash outflow, you have sufficient data to get operating cash flow, and you also have sufficient data to get the terminal cash flow. So with this information, I want you to calculate net present value. With this information, calculate net present value. If nothing is mentioned, then the release of working capital is anyways 100%. My guess is on the level 2 exam, they would generally not have a different release ratio, because that will bring in tax complication. So my guess is most probably on the level 2 exam, you're looking at a 100% release ratio. It seems Jigger has already got the answer. It's impossible to do it manually, Jigger, unless and until you're doing it on an Excel file. And if you've done it on an Excel file, that's impressive. He's got the answer. I don't know if that's true or not true, but it seems interesting. Maikun is asking, PP sold cannot read 400. Yes, it's $400. My apologies if I'm not able to pronounce your name properly. Jigger did this on Excel, yeah. So I anyways have, I wanted to give you a little bit of flavor of financial modeling, at least the Excel part of it. So I have built one case study from you. I've built one case study for you. So once example 2 is over, I'll be taking you to that particular case study today. Okay, I already see a lot of answers on my screen. Uh, Most of you have posted. Utpal, Aniket, all of you guys have posted 1873. Kaushal, Sangeeta, yes. Some people uh, have different answers as well. Yash has 1703. Who else? Let's check. 1703. Maria has 1703. Rakshita has 1874. Okay. Uh, should we solve this together? So again, we will break it down into three parts. I'm going to solve this now. It's going to be a lot of fun. We will have to worry about three cash flows, right? We have to worry about three cash flows. Okay. So let's start with the initial cash flow first. So initial investment. Initial investment. So let's see what we have. PPE and net working capital. So property, plant and equipment 1000. Net working capital 400. So your initial investment is 1400. How many of you got this right? How many of you got this part right? Okay, don't be too proud of yourself. Yeah, even kids, even kids could have done this easily. Uh, then what we do is we do terminal cash flows. So what do we have in terminal cash flow? We release net working capital. We release net working capital. We release net working capital of 400. We release net working capital of 400, and what else? We're going to sell the asset. We're going to sell the property, plant and equipment for how much? 400. Then we will also have to pay taxes, right? So taxes of how much? So we've anyways charged 100% depreciation. So book value or the tax value is 0, and we sold it for 400. So on that 400, at 40% we will have to pay. At 40% we'll have to pay taxes. So tax would be 160. It's an outflow here. So let's look at the net cash flow. How much is that going to be? That's going to be 640. Okay, so 2 out of the 3 pieces we've been able to solve, 1400 and 640. Now what we're going to do is we're going to calculate the sales for the 5 years. So 1, 2, 3, 4 and 5. Let us start with sales amount. The first one was given 1200, and let's grow this at the rate of 25%. So let me fire off my calculator here. 1200 into 1.25. So 1500 is the next year, into 1.25, 1875. 1875 into 1.25. It's 23. I'm going to round it off. 23 to a higher number. 2344 into 1.25, and I'm going to round it off to higher number. So that's 2930. So these are my sales. Now once we have that, we have the operating fixed cost. Now that's going to be easy. Every year the cost is 200, so we just deduct that 200. These are the times when I feel that if my handwriting was better, life would have been nicer. but I somehow have to live with what I have. Variable cost 30% of sales. So 1200, 30%, 360, 1500, 30%, 450, 1875, 1875 into 0.3. I'm going to round it off to higher number, 563, 2344 into 0.3, 703. Now this time rounding it down, 2930 into 0.3 is 579. So that's variable cost, but don't forget that we have this depreciation to take care of as well, right? So let's look at depreciation now. So what do we have with depreciation? 40, 20, 20, 10, 10. So 400, 200, 200, 100 and 100. Now once we've taken care of all of this, what we do then is profit before taxes. So 1200 minus 600 minus 360. So first year profit before tax is 240. Let's look at next year. 1500 minus 400 minus 450. 1500 minus 850, so we have 650 here. Then 1875 minus 200 minus 563 minus 200 again, we have 912. 2344 minus 200 minus 703 minus 100, we have 1341. And 2930 minus 200 minus 579 minus 100, 2051. So that's your profit before tax. Have I done something wrong here? Yeah, my variable cost in the last year is wrong, right? Yeah, thank you, that helped. 2930 into 0.3, they should have been 879. Thank you very much, guys, you saved me. So 879 negative plus 2930 minus 300, so this becomes 1751. Okay. So now we have profit before tax. I'm getting a little lazy here, so I'm going to skip the tax part. I'm just going to look at profit after tax. So what I'll do is what is the tax rate given? 40%. So I'll multiply this number with 60%. So 240 into 0.6. So my profit after tax for each of the year. So first year my profit after tax becomes 144, then 650 into 0.6 becomes 390, 912 into 0.6 becomes 547, I'm rounding it down, and 1341 into 0.6 is going to be 804, and 1751 into 0.6 is going to be 1051. But it doesn't end there, because remember I told you those areas where things might go wrong. One of them was depreciation. So we have to add back depreciation. So depreciation of how much? For first year 400, then 200, then 100, then 100. Let's see what that leaves us with. So we left with 544. Okay, it's getting too cold here. Oops. 544. Then we left with 590. We left with 747, 904, 1151. And there you go, finally job done. And now let's get the NPV calculations out of our way so that we can relax a little. So what do we have here? Is my depreciation no, who said that? Okay, so can you please confirm if my calculations are correct? Niti, my calculations are correct. You will have to look at the question one more time. So 0, 1, 2, 3, 4, 5. Niti, no, that's incorrect. What you're saying is incorrect. 1400 negative here. 544, 544, 590, 747, 904. I'm already thinking of my dinner plans now. 1151 plus 640, and we discount at the rate of 10%, and that gives us NPV of how much? So let's do it. Cash flow, second clear work. 1400 negative is cash flow 0. Cash flow 1 is going to be 544. Cash flow 2 is going to be 590. Then 747, 904, and then 1151 plus 640. Enter NPV 10. Enter compute NPV, and I'm getting answer as 1873. I'm rounding it up. And all those of you who got this right, that is super impressive. I think within couple of hours you guys picked up the skill and you picked up the concept, so that makes me very happy. It's an evening well spent for all of us. And those of you who made a mistake, ask me. Let's see if we can fix your doubts. Yes, any questions, any doubts, anything you want to ask? Okay, Anup is asking, can you repeat the PPE part again? So Anup, PPE part was kind of simple here. You parked in 1000, so 1000 becomes the initial cash outflow, and then you charge depreciation. The schedule was given 40, 20, 20, 10, 10. So you just do 1000 into 40%, 20%, 10, 10, 10. That's charge the depreciation, add back the depreciation. Your book value of PPE becomes correct, Anup. So I'm trying to answer that. So your book value of PPE becomes 0 because you've charged the whole depreciation, but you sold it for 400. So 400 is your profit. So 400 comes in, but we have to pay tax on that at the rate of 40% because 400 is profit. So we pay tax of 160, and that's how we get the terminal cash flow. Thank you, Yash. Thank you, Raja. Question Aniket has asked is, what if there's an operating loss? I'll be covering one of that scenario in tomorrow's session, Aniket. Same timing. Nishant, all the PDFs are available in the YouTube description of the video. So we generally post a link, or we post a link in the comments, either of the two places. Utpal is asking, is this representative of a level 2 case study? Yes, we're fairly close. Sushmit, your method will also work. Pravleen is asking, what if depreciation was not 100%? So Pravleen, we have to do that scenario tomorrow. Yes, yes, most of them. Level 2, yeah, about 70 to 80% of them. Thank you, Gulmira. Is this an easier question from the level 2 exam? Yeah, it's kind of the easy part. I mean, I wouldn't say it's the most, I wouldn't say it's the easiest. It's probably 10%, 20% below the level 2 exam. But it's there. We're more or less there. So we'll be there. Thank you, Sonal. Okay, so now here's what's going to happen now. I wanted to do one Excel based case study with you. So I had written one case study which I basically looked at CFA curriculum examples, and from that I wrote a case study. Okay, so this is a case study where it's on the similar lines, but we'll have to I mean, we can do it on a pen and paper, but I think doing it on Excel would be easy. So I wanted to do that now, but it seems we definitely will not be able to finish it. So we will do it tomorrow. But here is what I'm going to do now. What I'm going to do is, so basically, what I want is, I want you guys to write some comments on the video, so that video becomes popular and more number of people seeing it, and somehow we'll be able to break that subscriber of 70,000 range that we are in right now. We've been stuck in 70,000 for ages, and I want to somehow take it to 80, for which I need few popular videos. So here's what I'm going to do now. What I'm going to do now is I will do this case study tomorrow, but in the meanwhile, if you write some sort of a comment on the, okay, it's very stupid, but let's see if it works. If you write some comment and if you drop your email ID, then I will personally email this particular case study to you, and then tomorrow when we start the session, you would probably have 5-10 minute advantage. It probably work, it will probably not work, but I'll see if this works. But in either case, my request to you is, once the video gets uploaded, updated, it gets updated about 5 minutes after the session gets over. Please write some comment. I think that just makes the video a little more popular in the YouTube search. And if you guys have not subscribed, please do. Now we are stuck in that 70,000 range. I want to take it to 80,000. Hopefully that will happen soon. Okay, so with this, from my side, I am done. Yeah, and yeah, please, thank you, Madhur. Yeah, please like the video in case if you like the session. Just participate on the YouTube so that we will be able to increase the popularity of the channel, which I have been trying really hard to do, but somehow it's not going at the speed at which I would like it to go. Thank you guys, thank you very much, I appreciate. So should we call it a day? Okay, thank you very much, expat.